We often hear about people being partners in partnerships. There are big partnerships, like the big accounting and law firms. There are also much smaller partnerships, such as two people running a small marketing firm together. But what exactly is a partnership? Firstly, let's look at what a partnership is not. Unlike a company, a partnership is not a separate legal entity. So technically speaking, when a partnership owns an asset or owes a debt, it is the partners of that partnership that own the asset or are subject to the liability. Furthermore, if the partnership has a debt and one of the partners cannot pay, the other partners are personally liable to pay for all of the unpaid amount, even if it means having to sell their personal assets. The tax definition of partnership in section 9951 has two limbs, and taxpayers that come under either of them for tax purposes will be considered to be carrying on a partnership. The first limb captures those that are carrying on a partnership at general law. Case law, which has been codified in most states' partnership acts, determines what a general law partnership is. Basically, it is when two or more persons carry on a business together with an intention to share their profit. Peggy and Sue are two accountants that work in the same office premises under the same business name and who share their profits. They are very likely to be running a general law partnership. Such a partnership, like most general law partnerships, is likely to have a partnership agreement. This agreement gives details about when the partnership commences, how it is to be run, how profits are to be split, and other relevant information about the conduct of the partnership. However, it is possible for there to be a general law partnership in the absence of such an agreement, if the requirements of a general law partnership are still fulfilled. So in this scenario, even if Peggy and Sue do not have a partnership agreement, it is highly likely that they would be regarded as carrying on a general law partnership. The second limb of the tax law definition of partnership is persons in receipt of income jointly. This covers a situation such as when two people own a rental property in joint names and collect rent on it. Such persons are not carrying on a partnership at general law, since they are not carrying on a business together. However, since they are receiving income jointly, they come under the second limb of the tax law definition of a partnership. Now that we know what a partnership is, the next question we need to think about is, what are the tax implications of carrying on a partnership? If there is a general law partnership, then there are two steps involved regarding the tax implications. The first one, under Section 91 of the 1936 Income Tax Assessment Act, is for the partnership to lodge a partnership tax return. This return will state the partnership's income and deductions, and so calculate the net income of the partnership. However, the partnership itself will not pay tax on this because it is not a separate legal entity. The second step, under Section 92 of the ITAA 1936, is for each partner to account for their share of the partnership income or loss in their own personal tax return. So, if the partnership made a profit, each partner's share of the net income will constitute assessable income in their tax return, and they will individually pay tax on their share of the profit. If the partnership instead made a loss, each partner's share of the loss will be a deduction in their personal tax return. This is one advantage of a partnership over a company or trust, because it means that the partner can offset their share of the partnership loss against their non-partnership income. If an individual partner does not have sufficient non-partnership income to offset such a deduction, then they will have an individual tax loss, which can be carried forward and offset against future income. If there is a partnership under tax law only due to it coming under this second limb of the definition, then in practice, each partner's share of the income goes straight to their individual income, without having to go through this two-step process. Another important distinction is that if there is a partnership at general law, the partners can decide between them how to split up the partnership profit. But if there is a partnership only because it comes under the second limit of the tax law definition, then the profit must be split up proportionately to the interests in the jointly owned asset.